Hello, my name is Mike Cece. I will be your presenter for the next 35-40 minutes. Let me welcome you all to GWH Advisors and Accountants Steps to Success educational series. Before we get started, please read this compliance memorandum. This is our disclosure that's required to be displayed at the start of each presentation. Please review it carefully. Now, tonight's workshop is the first in a series of financial literacy. It is designed to be an interactive workshop, and we encourage you to ask as many questions as you like. We find that we learn as much from the questions that are asked as we do from the planned material. However, from doing these types of workshops all around the country throughout the years, I understand that people are hesitant to discuss their personal finances in a public forum like this. So we offer each attendee the opportunity to meet with an advisor in our office in Newtown, Pennsylvania, on a one-on-one basis to review your homework. That's right, we're going to have several homework assignments and discuss your personal finances. This meeting is complimentary and can be utilized to help you formulate a financial plan. Now let's talk personal finance. Personal finance is a crucial aspect of everyday life. Management of your financial activities is an ongoing process. It involves budgeting, smart savings, prudent investing, and comprehensive planning. Educating yourself in these areas is essential for long-term success. Keep in mind, people don't plan to fail. They just fail to plan. It's a proven fact that people in the USA spend more time planning their vacations each year than they do their financial future. Think about it in your own situation. When you plan a vacation, you meticulously plan every detail from the time you leave your house until you return. You know how you're getting to the airport, you know how you're getting to your hotel, you know all the amenities that that hotel has to offer or the Airbnb. You plan every detail. I'll bet you haven't spent that much time planning your finances, right? Well, tonight is a good first step. So let's take a look at the agenda. Today, you're taking the first step in successful financial planning, educating yourself on these 4 steps to success: budgeting, smart savings, wise investing, and strategic planning. The second step, as I said before, will be the one-on-one meeting to put all the information together in the formulation of a customized plan specifically designed for you so that your finances go as smooth as your vacations. Now let's get started with budgeting. Without a budget, you have no foundation to build on. It's your starting point. I like to refer to it as point A. Without a budget, you are just wandering aimlessly around trying to figure out what you need to do next and ultimately accomplishing very little, if anything. Now, there are plenty of online tools that you can utilize, but before you sign up for one of them, I suggest you start out the old-fashioned way with paper and pencil. This will help you create your budget. This is homework assignment number 1, create a budget. Let's explore how to get started. Identify your top 2 or 3 short-term and long-term goals. For example, saving money for that bachelorette or bachelor party in Nashville, Austin, or Vegas. That's a short-term goal. Plan for moving out of your parents' basement, getting your own place to live, maybe save for a down payment to buy a house. That may be a long-term goal, but write them down, as many as you want. Wait a couple days and then review them. Some will seem reasonable and some will seem not so reasonable, like buying that new motorcycle or buying those expensive concert tickets. you may end up crossing them off your list. But once you have that list, then you need to divide your paper in three sections and label them needs, wants, and savings. This is a crucial step to success. Just like businesses that fail because they confuse cash flow with profit, people fail because they confuse total income with spendable income. Now let's look at how much we allocate to each of those categories. Let's discuss what I refer to as the 30-50-20 rule, or actually the 50-30-20 rule. And that is your homework assignment number 2, dividing your spendable income into 3 categories. 50% allocated to needs, such as shelter or rent, utilities, gas, cell phone, TV, internet, insurance, and of course, debt. The 30% is your entertainment, such as those concert tickets, vacations, gifts, or impulse purchases, things that you purchase on a whim that you probably really don't need. And finally, 20% to savings, building an emergency fund or a cash reserve, as well as investment dollars. Now, keep in mind, you need to be flexible, shifting these percentages up and down based on your current situation. But ultimately, you want to get to the 50-30-20 split. Now, once you have completed this task, you need to evaluate your debt. And that's homework assignment number 3. Make a list of all your debts. Write them down, the interest rates for each, especially your credit cards. Then characterize each item as bad or good debt. As you can see from our charts, how to characterize them. This is something we will help you with in the one-on-one session, where we will work with you not only to establish your debt, but to establish a strategy to pay down your debt. Now let's talk about putting your savings dollars to work for you. Let's discuss the basics. Rule number 1, pay yourself first. You are the most important participant in your financial plan. Write this down. The true formula for financial success is systematic savings plus compound interest and time will give you a successful long-term financial plan. You also need to understand the power of 72. How the power of 72 determines how long it takes you to double your money. For example, at 10% interest, it takes 7.2 years to double your money. You divide the 10 into 72. At 12% interest return, it takes you 6 years to double your money. And converse to that, at 6% interest, it takes you 12 years to double your money. Now, how does compound interest come into play? Why, I always like to explain this with a little story where I like to bet my participants and anybody who's willing to take advantage of this, where I'll give you or you'll give me a penny a day and double it for 31 days. And at the end of the 31 days, I'll give you $1 million. Are you willing to make that bet? Well, through the power of compound interest, a penny a day and double it at the end of 31 days will be worth $10,737,418.23. Now, I know you're all going to reach for your calculator, but I guarantee you that's what the number will be after 31 days. So that's the power of compound interest. So systematic savings, putting money away for yourself first on a monthly basis, whether it be $25, $50, $100, whatever that number be, you need to get started and let systematic savings, compound interest, and time be on your side. Now let's talk about investing. And what we want to talk about is moving from being a saver to an investor. The difference between saving and investing. That's the difference between loanership dollars and ownership dollars. Loanership dollars is when you lend your money to an institution like a bank and they pay you a small rate of return. They take those dollars out the back door and they invest them and they make double or three times the amount that they're paying you, and they're making money on the spread. That's why you have these large bank buildings all over town. That's ownership dollars. Ownership dollars is where you invest your money, maybe in a stock, and there you're taking an ownership position in that company. And your success depends on the success of that company. If it's a good product or a good service, it's going to make money. And if that makes money, you make money. So that's what you have to do is transition yourself from being a saver, and I'm sure you're all very good savers, to being a true investor, moving from ownership dollars to ownership dollars. Educating yourself about financial markets starts today. So my first tip to you is beware of the stock tip. What we hear a lot of people say, oh, you talk about investing in stocks, but I've been burned before. Sure, you listen to your friends, you go to a party or you're out somewhere at an event, and people are talking about how they invested money in their Robinhood account and bought a stock, and the stock went up and they sold it and they made money. And you start to think, boy, maybe I should invest in the stock market. So you take a little bit of your savings and you put it in the stock market and you buy that stock they were talking about. And the first emotion kicks in, hope. You hope that the stock continues to go up. And it does. It goes up for a week, goes up for a month, and all of a sudden the second emotion kicks in. Does anybody know what that is? Greed. So you sell your car, you sell your dog, you get all the cash you can to get together, and you invest more money in that stock. You put it all in there. And of course, that emotion of hope kicks in. You hope that it continues to go up. But the one thing we know is that the stock market goes up and the stock market goes down. It goes up and it goes down. It's volatile. And unfortunately, the stock market starts to go down and that emotion of hope kicks in. You're hoping that it turns around. But unfortunately, we're probably into a slight correction, which means the market is going to go down until it hits a bottom. So it continues to go down and it's below where you even paid for it. And that last emotion kicks in, which is fear and panic. And you sell and you lose money. And that's what we call the small investor theory. You can't fear the stock market. You have to understand that it's volatile. It goes up, it goes down, it goes up and goes down. And a little bit later on, we're going to show you how to take advantage of that volatility in the market so it works for you. You're actually going to invest money and hope that the market goes down, because if it does, you'll make even more. So let's talk about each individual type of investment and how you get paid. First, we'll talk about stocks. Stocks pay you in two ways. They pay you in growth and share value, which means if you buy a stock at $10 and it goes to $12 and you sell it, you've made $2 a share. That's growth and share value. The second way that a stock pays you is dividends. Those dividends are usually paid quarterly, but some are paid on a monthly basis. But this is when you invest in a company and that company has profits every quarter, they add up their profits. And by prospectus, they need to distribute those profits to their stockholders. That's you. So they issue a dividend on a quarterly basis or a monthly basis. And that's the second way that you get paid by a stock. So you get paid by growth and share value, and then you get paid by systematic dividends, either monthly or quarterly. So if income is one of your objectives, then you want to invest in stocks that pay those dividends. However, if growth is your objective, then maybe you want to invest in stocks that don't pay dividends, but take those profits every quarter and reinvest them back in the company to grow and expand, or to buy more inventory so they can make more profits. That's a growth stock. And that growth in share value will grow a lot faster than a dividend paying stock, in theory. Now, the second type of investment that you'll hear about are bonds. Bonds are debts. You take a debt position either with a company in the form of corporate bonds or with a municipality where they need to raise money to improve their roads or some sort of highway project, whatever. Or corporations need it because they don't want to go to a bank and borrow money because the rates are too high. So they'll issue bonds at 5 or 6 or 7% rather than borrow money from a bank at 9, 10, or 11. And you buy the bond usually in $1,000 increments, and they pay you a fixed rate of interest for as long as you hold that bond. If you hold that bond to maturity, you'll then get your $1,000 returned on the maturity date, whether that be 5 years, 10 years, 20 years, 30 years. Now, bonds also fluctuate in value. Their fluctuations are tied to interest rates. If interest rates go up, the value of a bond will go down. So if you're holding a bond at 5% interest and interest rates go to 6, then the value of that bond goes down. And if you sell it early, you'd be selling it at a discount. Converse to that is if you hold a 5% bond and interest rates go down to 4, the value of that bond will increase and be selling at a premium. So if you sell that bond before the maturity date, you can sell it at a premium or a gain. So you get paid bonds by systematic interest payments, either on a monthly or quarterly basis for the term of the bond, or you can have growth in the share value, growth in the bond, the value of the bond, the premium, if interest rates go down while you're holding that bond. But in any event, no matter what happens with interest rates up or down, if you hold the bond to maturity, it'll always be worth its face value. The third type of investment is mutual funds. Mutual funds is a pooling of assets. It's a way they take my money and your money and everybody else's money, and they pool it all together to allow us to purchase either a group of stocks or a group of bonds or a combination of stocks and bonds. This way you get a lot of diversification. You're not all your eggs aren't in one basket with one stock. It allows you to diversify your money and still participate in the stock and bond market. Now with mutual funds, you get paid 3 ways. You get paid with growth in share value. You buy a mutual fund at $10 and eventually it sells at $10.50 or 11 or 12. That's growth in share value. Keep in mind, you can also have negative growth where you can buy it at 10 and can go down to 9.50 or 9, depending on the performance of the underlying holdings. The second way you get paid in mutual funds is dividends. As we mentioned before, stocks pay dividends. So the stocks that they hold that pay dividends will be paid to the mutual fund, and the mutual fund is then obligated to pass that through to its investors. So you get paid through dividends. And you can either buy more shares of the mutual fund or you can take it as income. And the third way you get paid in mutual funds is that once a year, usually in December, the mutual fund company adds up all the stocks that they bought and sold that made a profit, and they subtract that from the stocks that they bought and sold that they lost money. And the profit should be a lot greater than the losses. And then in December, they distribute that to the shareholders in the form of capital gains. And that's why you'll see large capital gains distributions from your mutual fund companies, usually in the month of December. And the fourth investment option available to you are called ETFs, exchange traded funds. Again, this is a pooling of money like mutual funds, where they take your money and my money, you put it into a pool, and then they invest in indexes, either stock indexes, international stock indexes, bond indexes. But what makes the ETFs more advantageous to mutual funds is one, they're lower cost because there's not as much active management. And two, they're more tax efficient since they're not paying out dividends and capital gains. But it does have growth in share value. So ETFs are a low cost effective way to diversify your portfolio. So stocks, bonds, mutual funds, and ETFs are the four basics for investments, and that's how you get paid. Now let's talk about the three fundamental principles of investing. How do you have the equity markets or the bond markets work to your favor? Fundamental principle number one is diversification. That's where you take your money, you invest it, and you diversify in a multitude of stocks. Now, you can do that through a mutual fund. If you have a large enough portfolio, you can diversify on your own. But you want to buy different types of stocks as well. You want to buy financials, you want to buy energy, you want to buy international, you want to buy small cap, large cap. So you want to be able to diversify your portfolio over many industries. This will not only give you some downside protection, but give you the opportunity to grow your money when certain industries outperform others. Now, working with a money manager, once that money is diversified, they want to weight based on the research they have. Maybe they want to weight it towards technology because that's going to be in favor in the coming quarter, or they'll weight a little heavier towards financials or utilities. So they're constantly managing how that money is diversified and overweighting or underweighting certain aspects of the portfolio. That's how you make money from diversification. The second fundamental principle is asset allocation. So before you invest in the market, you need to determine what I like to refer to as your sleep factor, your ability to sleep at night. What may be a good investment for me may not be a good investment for you if you have trouble sleeping at night worrying about what your money's doing. It's not whether the investment is good or bad, it's about whether or not it's good for you. So you need to determine your sleep factor. And the way we do this, and we'll talk about this in your one-on-one session, is determining a number between 0 and 100. 0 being very, very conservative or risk averse, and 100 being very, very aggressive. And most people fall somewhere in between there. But you determine your sleep factor, and then you allocate your portfolio based on how much volatility you're willing to take. The more volatility, the higher the stock amount, maybe 80% in stocks, 20% in fixed income and alternatives. If you're a little bit more conservative, less volatility, maybe 60% in equities and 40% in fixed income. And we can go up and down depending on what your sleep factor is and how you adjust over time. But the main thing is to get it so that you're comfortable sleeping at night, not worrying about how your money is doing. And then the third principle, and this is very important, is dollar cost averaging. Taking advantage of the volatility in the market. Dollar cost averaging allows you to take advantage of the volatility in the market. If you remember earlier, we talked about the small investor theory. Well, if you use dollar cost averaging, then you can use that volatility to your advantage. For example, if you're saving $100 a month systematically, and the first month you buy a stock and it's paying $10 a share, so you buy 10 shares, $10 into $100, you bought 10 shares. Unfortunately, you bought it at the top of the market and we're getting ready to go into a deep correction. And the next month, the stock drops to $5. But you're investing systematically, so you put another $100 in. This time at $5 a share, that stock is currently paying, you're buying 20 shares. So now you own 30 shares and you invested $200. Most people think their average price per share has come down to $7.50. But actually, if you take 30 shares and divide it into 200, your average price per share is actually $6.66. So that when that stock eventually comes back up to $10 a share, you've now invested $200, you own 30 shares at $10, and you sell it, it's now worth $300. You invested 200, you made 300, and the stock never went above your original purchase price. It's now, what was your gain? Your gain was 50%. You made 50% on your money through the volatility in the market, and the stock never went above what you purchased it as. That's the power of dollar cost averaging. Now, many of you are already doing that. If you're in a employer 401k plan, you're systematically putting money away every paycheck. And if you're lucky enough, your employer's matching that. And then you're investing that in the market. So you're buying fewer shares when the market's up, and you're buying more shares when the market's down. So you're looking for volatility. You want the market to go down, and you want the market to come back up. And that's how dollar cost averaging can help you take advantage of the volatility in the market and make your portfolio much more profitable. So don't fear volatility, take advantage of the volatility. And in conclusion, I just like to say, it's not where you end. Don't look at the end. Look at the beginning. It's where you begin. Even if it's as little as $50 a month or $100 a month. The key to financial success is getting started. The earlier you start, as you can see from this chart, the less you need to save in order to accumulate a large sum of money because you have time on your side. So start now. That's systematic savings, utilizing compound interest over time is how you're going to be successful. I like to conclude by saying, don't forget your homework. Write down your goals and objectives, your short-term, long-term goals, review them, bring them in for your one-on-one meeting, and we'll review them with you. We'll also look at your needs, your wants, your savings, work on your 50, 30, 20 portfolio, identify your debts, identify them as good and bad, and then set up a strategy to pay down those bad debts. And anyway, get you started on developing your own customized financial plan. What you do with that plan afterwards is up to you. You can implement it on your own, you can implement it with us, or you can throw it in the trash can and just mark it up as a experience in life. But in any event, get your homework done. I wish you all good luck, and I hope to see you when you come in for the one-on-one meeting. Have a great day.